From New York City, for our viewers worldwide, I'm Katie Greifeld in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, an absolute parade of Fed speak. Data still showing a still strong U.S. consumer and Treasury yields all over the place. We begin with the big issue, timing the growth shock.
We're going to see the growth slow down.
The key issue at the moment is the sequencing of hitting the Fed's dual mandate.
It's timing that, trading that. That's going to be hard.
You won't really see the full effect of this tightening probably until, possibly even the midpoint of next year.
Q2 to Q4, maybe even as late as Q1 of 2024.
There are significant lags to Fed policy.
The lags between monetary policy tightening and the effects in the real economy.
That's going to be a bigger problem.
This is not a time to get too cute.
The investable windows are really short.
It's going to be very difficult for markets to digest.
Joining us now, Morgan Stanley's Srikanth, Flowbank's Esty, Dwek, and Greg Staples of DWS. And Greg, let's start there, and let's talk about that very fine needle that the Fed is trying to thread. You have inflation, trying to bring that down, all while trying to not destroy growth. How possible is that at this point?
It's going to be very difficult. First off, you talk about a growth slowdown. Now, the reality is the fourth quarter of 2022 might actually be the strongest quarter of the entire year, given that weak numbers we saw earlier in the year. Going forward, it's very odd because this is the first time in my career I've seen more than half of the economists predict a recession in 2023 when we're not in one now. As a general rule, street economists don't like to predict recessions going forward. They tend to be a little bit more optimistic. This time around, they're predicting a recession. And it's almost as if that is self-inoculating, because if you're a business, you're already taking the steps that are going to prevent a real slowdown hurting your business overall. And so that might actually soften the downturn. As far as the Fed is concerned, I think they've got the tools to perhaps keep it rather shallow, or they're going to be very nimble in 2023 about putting that last few tightenings on to make sure that they don't overdo it and get a real negative economic outcome.
Well, Sri, to Greg's point, a nimble Fed in 2023. It's great to have you on because you just published your 2023 credit outlook, and the Morgan Stanley house view is that the Fed pauses in March. Why is that? Walk us through that. Is that a recession call?
No, it's not a recession call. So we are solving for slow growth, but a U.S. economy that just about manages to avoid recession, so call it 50 basis points of year-on-year growth, is what our econ team led by Ellen Zentner is forecasting. So what drives the Fed pivot is to some extent the easing inflation data. Again, it's not a Q1 story, but to some extent the inflation data starts to show some element of approaching a peak, and we do see some degree of inflection coming through in the back half of 2023. So the thought process here is that you are getting the slowdown with respect to growth. You are getting the slowdown with respect to the inflation to some extent, and that drives the confidence around at least holding pattern for a while rather than pushing even further into restrictive territory.
And Sri, you said something interesting there. We were talking about a pause, and then you brought up the concept of a pivot. So if the Fed pauses in March, do you think that they stay there for a while, they hold rates there, or how quickly does a cut come after that?
Yeah, I think that is the critical question for corporate credit markets in my perspective, because the way we're solving for this is that for the most part of 2023, it is holding at those restrictive levels, call it around 475 on the upper end of the Fed funds target rate. And we do expect, our economist team does expect the first cut to come through at the very end of 2023. But again, that is further out, and we do need to see that validation from the inflation data before we get more confidence around the cutting path. And that's kind of why we're framing the credit market as being stuck between a pause and a pivot. And it is the length of the pause that is going to be critical for the performance of a lot of the weaker corporate credit markets.
Well, we're going to dig into credit all in just a few minutes, but Esty, I want to bring in you here. We've gotten the Greg Staples view. We've gotten the Morgan Stanley house view. What's your view on this Fed?
I think we're coming to the end of the aggressive part of the hiking cycle. I think we are starting to see that the hard inflation data is matching up with all of these indicators we've had that inflation is coming down. So we're going to get the 50 basis points in December. We might get another 25 in January. And then I do agree that we're going to have some kind of pause, but then the Fed is going to have to be very careful on rhetoric to make sure that medium-term inflation expectations do not become unanchored, that these rate cuts don't get priced in any sooner, even if growth slows, or that they can manage to price out those Q4 2023 rate cuts. So they're going to have to continue to sound tough and keep policy restrictive while having that pause, because they definitely don't want to get anywhere towards more of a loosening in financial conditions either on any indication that they're pausing.
Well, as you guys know very well, we've just have an embarrassment of riches when it comes to Fed speak, to that rhetoric. I want to highlight something that St. Louis Fed's Jim Bullard said this week. He said, and I quote, "Even under these generous assumptions, the policy rate still isn't at a zone that might be considered sufficiently restrictive. To get to this sufficiently restrictive level of policy, we'll need to increase the policy rate further." And Esty, we got a different word there. We got two words. We got sufficiently and restrictive, not just restrictive. When will we know when we're finally at that sufficiently restrictive zone?
I'm not even sure the Fed knows at this point exactly where that level is. We should be coming close to restrictive policy. We have a labor market that is holding up a lot better than expected. We continue to have those low jobless claims numbers, and the non-farm payrolls have come in relatively strongly over the last few months. We are going to get there when the Fed tells us that we're there, and then they're going to keep telling us and reminding us that we're there and that we're staying there. But at this point, again, I think we're probably only 50 to 75 basis points away. The market is pricing in that 5% terminal rate. Bullard is always on the hawkish, if not extreme, definitely on that end of the spectrum. So I think that 5% probably is capturing a lot of this already.
And Greg, on that 5% terminal rate prediction that you're seeing priced into markets right now, it caught my eye in the notes that you sent over that you're dubious the Fed can get to a 5% policy rate without something breaking. What specifically are you looking for to break here potentially?
You know, it's going to be very hard. Usually in history, when you've seen a tightening of monetary policy overall, some sector of the marketplace reveals itself to be overpriced and fragile, whether it be housing, whether it be .com, whether it be EM. We've seen something like that in crypto in the past week or two, but it really hasn't been systemic a threat. The overall broader market has pretty much shrugged it off. Tough to say where that's going to be, or maybe you don't even get a break like that. I think it might be just an overall more rapid slowdown in the economy once you get Fed funds that high, an S&P that goes down to 3,200, and a real sharp slowdown, slower than they'd like to see.
Sri, I promise I'm not going to ask you about crypto, but I want to dig into that idea that we could see something start to break here as we approach 5%. I want to turn that into your house call, the fact that the Morgan Stanley view is that the Fed is going to pause ultimately in March. What's the bigger risk to the call at this point, that the Fed pauses before then or continues to hike past?
I mean, I would say that the short answer to that would be that, yeah, there is some risk to the upside. But the point that Greg made around the potential for a market accident, that's how we're framing it. That is one of those the kind of events which could force a faster pivot or change in direction from the Fed. So the distinction between kind of an economy and data providing that breathing space for a pause versus a market accident, which requires a more emergency intervention, that obviously needs to be made. For now, we're also kind of scratching our heads trying to figure out where the kind of cracks could be. We've highlighted some of the potential where you could look at what the hedge economics looks like, what a strong dollar potentially means for some of the international investors in fixed income. I mean, some of the private credit markets, et cetera. But these are not at a breaking point just yet. What we need to be cognizant of is that further we move into restrictive territory, the probability of some of these market accidents obviously continues to go up. For now, we're not there yet.
Sri Sankaran, Esty, Dwek, and Greg Staples all sticking with us. Before we get to break, I do want to bring you some breaking news. We have a headline crossing the terminal that the DOJ is opening an antitrust probe against Live Nation. That is according to the New York Times. And of course, Live Nation, that is Ticketmaster's parent company. Will continue to keep an eye on that. But up next, we're going to talk about Adidas making a rare appearance on the auction block. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld in for Jonathan Farrow. This is Bloomberg Real Yield. Time now for the auction block where we kick things off in Europe. That's where Adidas made a rare appearance, the company raising debt for the first time since dropping Ye and its first dive into the region's public debt market since 2020. Over in the U.S., more than $23 billion were sold this week, with the Philip Morris deal holding the distinction of the largest at $6 billion. The company is helping to fund its acquisition of Swedish Match. And Carnival hit some rough seas this week after it priced a $1 billion convertible senior note offering. One of its bonds at one point was the biggest loser in junk secondary trading. Sticking with credit, JP Morgan's Oksana Aronov weighed in on the big post-CPI rush into junk. Take a listen.
If we look at parts of the bond market that tend to break first, right, and that's certainly the lower-rated credit issuer, what we see there are spreads in the mid-400s, and that's below the 20-year average, let alone below a recession average. It's really telling and concerning, frankly, to me that we saw, last Thursday when this sort of rally really ripped, we saw $2.5 billion go into high-yield ETFs. This is all happening as downgrades are taking over upgrades in that sector.
Sri, Sankaran, Esty, Dwek, and Greg Staples still here with us. And Sri, let's start with you, since, like I said, you published next year's outlook today for the credit market. Oksana's waiting for pain, but you're looking for healthy returns next year when it comes to corporate debt. Walk us through that.
Oh, that's healthy total returns for sure, with the rates doing a lot of the heavy lifting with respect to delivering those returns. So when you think purely from the spread of the credit performance standpoint, I mean, there are three elements to what we're trying to emphasize here. One, 2023 will be a good year for income. So investment grade delivers that quality income. So we're thinking about that more as a range-bound spread environment, kind of modest positive excess returns. That is a credit component, but total returns being healthy because of the rates compression or the Treasury yield compression that our rates colleagues are anticipating. On the leverage credit side, I do take Oksana's point. I mean, it is valid that some of the outperformance in recent weeks in high yield is a little bit surprising, but to some extent, that's just the market pricing in more of a probability of a soft landing, so to speak, post the CPI data. And I do think that what we are trying to emphasize is that we want to own some of the credits which are already priced for a recession. So think about the deep discounted, lower quality stuff. Anything which is generate beta within the market, that's the pocket that we dislike. Own income, own convexity. That's our thesis for 23.
Greg, like Sri is saying, I mean, in every conversation about credit spread specifically, not total return, there's a conversation embedded in there about Treasury yields and that duration risk. Have we seen the ceiling in Treasury yields, and what does that mean for the credit market in your view?
I think we've seen the heightened Treasury yields for calendar year 2022. It wouldn't surprise me to see another run at 4% in early 2023. And indeed, it's likely if we get the Fed funds rate up to that 5% level that Mr. Bullard was talking about. In terms of credit spreads overall, we are sanguine over the longer term, but still think over the near term, we probably have a bit more risk. I mean, equities, I think have gotten ahead of themselves. This is the second pivot that we've had. We had that June-July rally, and now we've got another one going on again, and think that that's quite vulnerable. And obviously, there's a correlation between equity market performance and credit spreads overall. There could be some weakness in the near to intermediate term.
That's interesting because we have a little bit of disagreement here, perhaps. Sri saying that, he's looking for deep discounted names right now. Greg, it sounds like you're not quite ready to go bargain hunting.
Well, there's a little bit of a difference there. I think he's right in that you've got credit issuance that was done, say, a year ago when Treasury yields were much lower. You can buy good quality bonds at a dollar price of 75, 80, 85, and that cushions a lot of the downside if those credits run into trouble. I'm talking about overall spreads over treasuries that are running in maybe the 145 area that we think there's a little bit of widening that could come ahead as we get right around year end.
And so, Esty, I want to bring you in here specifically on the notion of spreads, because I read that earlier this month you said that we could see global spreads start to tighten over the next year, that basically they've already been pricing in a serious growth scare. But sticking to the U.S., I look at IG spreads at about 140 basis points. I see high yield spreads at about 460 basis points. And that seems very low to me. But in your view, how much more could spreads tighten?
Well, I think a lot of it depends on your investment horizon and, of course, what is going to happen to growth over the next 2 to 3 quarters. We've seen spreads be relatively resilient, and as you say, they are quite low at the moment, considering the hiking that's happening and the worries about the growth picture. But I think we are already pricing in a significant growth slowdown. Now, the question is, if we get more of a hard landing, if it does seem like the Fed isn't going to pause, if we do start to get very, very strong lag effects from the recent tightening and we have a bigger impact on growth, there's certainly risks to see widening in spreads at some point, the way we've seen reactions in equity markets. But if you look at 2023 as a whole, it does feel that we are going to have, as some of my colleagues were saying, a better overall performance. And if we do avoid a very serious recession, then I think we probably have some potential for spreads to tighten, not very much from here, but at least to stay contained. And with any move lower in the yields overall, then you'd get a nice performance.
Well, Esty, let's talk about entry points here, because we heard from BlackRock earlier. This was in a Bloomberg News interview. Carolyn Weinberg saying that we are at the beginning of a rotation as investors come back into credit. With the rapid move in front-end rates, the curve has repriced credit to attractive levels, particularly as we approach the end of the Fed's hiking cycle. Esty, in your view, is this the entry point, or where is it?
It's starting to look like some of those entry points, and that's happened over the last couple of months. I do agree that we are reaching the end of the Fed tightening cycle. I think, again, we are going to have risks on growth and I think risks on inflation next year. If it doesn't continue to come down, that the Fed pause could be extremely short. But it is starting to be interesting entry levels. And as long as the growth picture is holding up relatively well, then again, those spreads should remain relatively contained, and we can start to add to those credit names.
Sri, I want to come back to you because in your outlook today, it caught my eye that you're talking about the ideal recipe for a sustainable credit rally. And it is Friday. I'm feeling pretty good. I want to dig into that optimism. What's the ideal setup for credit markets? Tell us about the different elements that you would need to see.
Yeah, I think that's an interesting one, right? I mean, if you do get the kind of softish landing, that the proverbial softish landing or soft landing, and I think the more important aspect of it, if we do enter kind of an easing cycle driven by inflation rather than a market accident or a recession fear, so the Fed gets into an easing cycle and a proper pivot into the back half of this year and back half of next year or in 2024, that's an okay setup for credit in the longer term, because that kind of avoids the problem with respect to the cost of refinancing at a time when those maturity walls are coming due. And to me, that's this combination of growth holding at these kind of levels or softer levels, but avoiding a recession, plus entering some sort of an easing cycle back to neutral territory into the early part of 2024, that's a decent setup for credit markets.
Greg, is that your ideal credit market setup as well?
It sounds like it, but I just have to stand back and say it's sort of a through the looking glass type of discussion we're having right here, because usually the bottom of the credit credit cycle happens when the fundamentals are at their weakness and we actually start to see an improvement in the economy overall. We're talking about a market cycle before we even had a hint of a recession yet. And now we're talking about a recovery from that. So it's sort of odd to me. I think we'll have to wait to see the economy actually slow down, start to impact fundamentals. That's when I'd like to actually see some weakness and some buying opportunities. Then when things start to look better from there, I think you're going to get a much better return profile from the credit cycle.
Well, before I let you go for this block, I mean, tell us what your timeline is then. I see your point that this is a sort of through the looking glass conversation. When might we actually see the downturn then, or are we in it?
Well, the fundamentals have yet to turn down, and I think if the Fed gets what they want, it's a softer landing. You see some weakness overall in credit fundamentals, not too much widening in spreads if that's a result, but then we also talked about the potential of them breaking the market in some place, whether it be high yield, whether it be private credit, who knows. And that could potentially engender another 25 or even 50 basis point widening in even IG, and that would be the time to actually buy. In terms of timing, I'm talking about first quarter of 2023, not too much beyond that.
Sri Sankaran, Esty, Dwek, and Greg Staples, everyone is sticking with us. Still ahead, it's the final spread. The week ahead, Fed speak continuing during the U.S. holiday shortened calendar. That's next. This is Real Yield on Bloomberg. I'm Katie Greifeld in for Jonathan Farrow. This is Bloomberg Real Yield. Time now for the final spread, the week ahead. Coming up, we have a host of Fed speaks starting this weekend with President Bostic on Saturday. Then we get Presidents Mester and Bullard on Tuesday, FOMC minutes and PMIs out of the U.S., Europe, and the U.K. on Wednesday, followed by just a slew of U.S. economic data. And finally, U.S. markets are closed on Thursday for Thanksgiving. But before we get there, it's time now for the rapid fire round. You guys know the drill. We have 3 questions, 3 quick answers. Esty, I want to start with you. Is the Fed's terminal rate above 5%?
No.
Sri?
No.
Greg?
No.
Esty, has U.S. inflation peaked for this cycle?
Yes, I think it has.
Sri?
Yep.
Greg?
I think it has.
All right, last question. What's more likely from the Fed in December, 25 or 50 basis points, Esty?
50.
Greg?
50, bet on it.
Sri?
That's an easy one. 50. Yeah.
All right, guys, this was great. My thanks to Sri Sankaran, Esty, Dwek, and Greg Staples. From New York, that does it from us. Same time, but on Wednesday next week. This was Bloomberg Real Yield, and this is Bloomberg.